Welcome to What Is, the channel where we explore the complex, the curious, and the commonly misunderstood. And today's question is, what is money? It's the lifeblood of economies, the source of wealth, opportunity, conflict, and often anxiety. We chase it, save it, argue over it, and try to master it. But what is it really? Is money just coins and notes? Is it a number in your bank account? Or is it something more abstract? Trust, belief, control? To understand money is to understand civilization itself. From ancient trade routes to modern cryptocurrency, from gold coins to tap to pay, money has shaped the way we live, work, and relate to one another. So let's unravel the story of money, how it began, how it evolved, and what it might become. Chapter 1: Life before money. Barter and early trade. Long before money existed, there was barter. In ancient times, humans exchanged goods and services directly. A farmer traded grain for fish. A potter swapped bowls for meat. A shepherd offered wool for firewood. This system worked in small, local communities, but it had serious problems. What if the potter didn't want fish? What if the fisherman needed shoes instead? This is known as the double coincidence of wants. For a barter to work, both parties had to want what the other offered at the same time, in the right amount. As societies grew more complex, barter became inefficient. It couldn't scale. There was no consistent way to value items, store wealth, or plan for the future. People needed something better, something everyone would accept, something we could all agree had value, even if it had no use on its own. That's where money begins. Chapter 2: Early forms of money. Shells, salt, and livestock before coins and paper bills. Early societies used commodity money objects with intrinsic or perceived value. In ancient Mesopotamia, barley was used as currency. In Africa and Asia, cowrie shells were prized for their beauty and rarity. In Rome, salt was so valuable it became the root of the word salary. Livestock, beads, weapons, tea bricks, even tobacco, anything portable and widely accepted could be money. Some forms were durable, others were more symbolic. In the Pacific Islands, the Yap people used giant limestone discs as currency, too large to carry. These stones stayed in place and ownership was transferred through verbal agreement. These early forms of money were about trust and tradition as much as material value, and they laid the foundation for what came next. Chapter 3: The invention of coinage. Around 600 BCE, the kingdom of Lydia, modern-day Turkey, minted the world's first metal coins, made of electrum, a naturally occurring mix of gold and silver. These coins were stamped with royal symbols to guarantee their weight and purity. This was revolutionary. Coins were durable but obliging, were backed by the power of the state and accepted across regions and borders. As empires rose, they minted their own coins. Rome, Persia, China, and beyond, each reinforcing the link between money, politics, and national identity. Coins made trade faster, taxes easier, and was more affordable. For the first time, value became something that could be mass-produced. Chapter 4: Paper money and promises. Paper money may seem modern, but it dates back over 1,300 years. In 7th century China, merchants began using promissory notes to avoid carrying heavy coins. These IOUs evolved into government-issued bills during the Song dynasty, backed by reserves of precious metal or grain. Europe was slower to adopt paper. By the 17th century, banks like Stockholm's Banco and the Bank of England were issuing paper notes. These weren't money in themselves, but claims on deposits, early versions of modern banknotes. As empires expanded, so did paper currency. It spread across colonies and continents, simplifying trade. Eventually, governments began issuing fiat money, paper not backed by gold or silver, but by trust in the state. A promise became more powerful than the metal it represented. Chapter 5: What makes money? Money? To function in society, money must fulfill 4 core roles. 1. Medium of exchange. Buy and sell things with ease. 2. Unit of account. Measure value consistently. 3. Store of value. Retain purchasing power over time. 4. Standard of deferred payment. Settle debts reliably. But that's not enough. Money must also be durable. Doesn't degrade, portable. Easy to move, indivisible. Can make change tangible. 1 unit equals another acceptable. Widely recognized, if money fails at any of these, it risks collapse. That's why trust, stability, and regulation are so important. Chapter 6: the gold standard and global trade. By the 19th century, major nations adopted the gold standard, a monetary system where each currency was backed by a fixed amount of gold. This created confidence in international trade. If your dollar could be converted to gold, and so could mine, we had a shared standard. But it also limited flexibility. Governments couldn't easily print money or respond to crises. Wars, recessions, and rapid growth pushed the system to its limits. The final blow came in 1971, when US President Richard Nixon ended the convertibility of the dollar into gold. The world moved to floating fiat currencies, where value is determined by supply, demand, and trust. Chapter 7: Credit, Debt, and the Banking System. Most money today isn't cash, it's credit. When you take out a loan, swipe a credit card, make a bank transfer, you're creating digital money. Banks use a system called fractional reserve banking, where they only keep a portion of deposits in reserve. The rest is loaned out, creating new money in the economy. This system powers economic growth, mortgages, education, and innovation, but it also creates debt, bubbles, and instability. When banks fail, trust evaporates. That's why central banks like the Federal Reserve step in to regulate the system, stabilize interest rates, and act as lenders of last resort. Chapter 8: Digital Payments and the Cashless Society. In the 21st century, money became almost invisible. With debit cards, online banking, mobile apps, and contactless payments, cash is fading fast. Today, billions of people pay with a tap or a click. In some countries, like Sweden or China, cash used so rarely that businesses no longer accept it. Digital money is faster, traceable, and convenient. But it raises concerns about privacy, security, and access. What happens to those without smartphones or bank accounts? The cashless society is coming, but it may leave some behind. Chapter 9: Cryptocurrencies and Blockchain. In 2009, a mysterious figure named Satoshi Nakamoto launched Bitcoin, a digital currency powered by blockchain, a decentralized, encrypted ledger that doesn't rely on banks. Bitcoin was designed to be borderless, decentralized. Only 21 million coins independent of governments. Other cryptocurrencies followed: Ethereum, Dogecoin, Solana, each with different purposes: smart contracts, decentralized apps, NFTs. Some hail crypto as the future of finance. Others call it speculative, volatile, and unregulated. Still, it challenges traditional ideas of money and raises powerful questions. Do we need banks? Who controls currency? Can money be purely digital? Governments are responding with CBDCs, central bank digital currencies, to combine the benefits of crypto with state control. The money of the future may not be printed, it may be coded. Chapter 10: Inflation, Crisis, and Collapse. Money doesn't always hold its value. Hyperinflation has destroyed economies. In Zimbabwe in the 2000s, inflation reached billions of percent. In 1920s Germany, people carried wheelbarrows of marks to buy bread. Why? When too much money is printed with too little to back it, trust breaks down. Inflation erodes savings. Deflation discourages spending. Stability is key. That's why monetary policy, interest rates, money supply, fiscal discipline is a delicate balancing act. When it fails, the consequences are devastating. Chapter 11: Inequality and the Power of Money. Money doesn't affect everyone equally. Those who have it accumulate more through investment, interest, and access to opportunity. Those without often fall further behind. The wealth gap is widening. A small group holds a vast share of global wealth, while millions struggle with debt, job insecurity, and financial exclusion. Money buys education, healthcare, housing, even influence. It shapes politics, media, and the laws that govern us. Understanding money isn't just about economics, it's about power and justice. Chapter 12. So, what is money really? In the end, money is not a thing. It's an idea. It's a system built on trust, maintained by institutions, and shaped by culture. A dollar, a coin, a crypto token, they all mean nothing if no one believes in them. Money is a medium of exchange, a symbol of value, a technology of coordination, and a story we all agree to tell. That story is constantly evolving. So, what is money? It's not gold or paper, not numbers on a screen. It's trust, it's belief, it's a shared agreement that something has value and that others will agree with you. From shells to chips, from coins to code, money reflects who we are. what we value, and how we relate to one another. And as our world changes, digitally, politically, and culturally, so too will the story of money. Because money isn't just what we spend, it's what we believe. Thanks for watching What Is. If you enjoyed this journey, don't forget to like, subscribe, and share your thoughts in the comments. What question should we tackle next? Until next time.